Well, the bottom line is we won't compromise on due diligence. These tend to be 10-year lockup vehicles, so mistakes can haunt you for many years to come. In terms of kind of avoiding these sins of omission, we try to maintain a list of target managers that we see as being good opportunities to invest in, reach out to them and try to develop relationships so that we're ready when they're ready to come to market. We also get an extraordinary amount of inbounds from a variety of sources, placement agents, GPs themselves, and with those it's really about trying to determine if there are any deal breakers early on, or if these are opportunities that warrant further diligence. So we start with some kind of high-level screens, really looking at performance as kind of a quantitative screen, and then we look at the team, the cohesion, stability, track record of the team. We also look at their ability to generate deal flow, and then I think the final kind of high-level screen is really alignment with GPs. It's the old adage: if you're not willing to invest in this opportunity, why should we? And then once we go through those screens, we've filtered out a number of the inbounds, or a good number of the inbounds, and then really focus on the opportunities that remain, and then going through a variety of decision points to get to our final investment list. Well, I do think there's been a lot of hype and also a lot of criticism of social media. There have been mistakes have been made, and there's also been a number of wins there. But I do see it as a long-term viable investment opportunity if done well. I think just the communication tool that it brings, the ability to create and share ideas with a virtual community, a virtual network, is very powerful. For investors that can attract the best entrepreneurs who can then bring the best ideas and can harness just the viral nature of social media, I think it's a lot of power and can drive great returns. I tend to believe the consensus forecast for slow growth in the U.S. and much of the developed world for the next couple of years. But I would look at venture and private equity as the top managers can still find ways to win in those spaces. On the venture side, if you look at a lot of great companies have been created in tough times, even if you go as far back as the 20-year depression of the late 1800s. You can name a lot of names, and I think that bodes very well for venture capital. It tells you that innovation happens even in the toughest times, and good managers can harness that. On the private equity side, it's a very competitive, in the U.S. there are over 2,000 managers, so they're constantly competing for deals and driving up valuations. But beyond that, with the current government effort to kind of support the economy has led to cheap, easily available debt. A lot of managers are taking care of that, I think, or taking advantage of that. I think the best managers are the ones that don't overpay simply because they have access to cheap debt. Rather, they might even see it as a selling opportunity, take advantage of the people or the parties that are willing to overpay. I think also the best managers have strong, vibrant networks. They have the ability to generate proprietary deal flow and somewhat mitigate some of those valuation pressures. So at the end of the day, it really comes down to investing again with top managers, and they ultimately will find ways to win even in tough economic environments. So for private equity and venture, we tend to be sector agnostic. We think if we invest with top managers, they'll identify the opportunities in the best sectors, source, grow, and exit those types of opportunities. From a geography perspective, we tend to see our portfolio over the long term as being one-third U.S., developed international, and emerging markets. And we do see emerging markets as the area that has the highest growth prospects, but it's also an area that's very challenging to invest in. You tend to have a choice between kind of the large fly-in type firms or local large firms as well that invest in the large cap space, which tends to be heavily intermediated, or the smaller firms that are raising lower funds or smaller funds, and you have to do a lot of sleuthing to identify those names. So as we looked at emerging markets, some 60% of the more recognized firms are in Asia, but once you get outside of Asia, there's not as much available. So you have to do a lot of digging to find those opportunities. Over 80% of those managers are what we would categorize in the U.S. as emerging managers, so they're raising fund 1, 2, or 3. So it's really heavy, laborious lifting to build that portion of the portfolio, but we think the long-term potential is there, and we're willing to do kind of that work there as well. And we also want to maintain the discipline there. I think you can point to various countries where people have lost a lot of money because they're pursuing kind of the growth story in a country and sometimes forgetting the manager selection story. And our intention is to try to avoid those types of mistakes by maintaining our same standard of diligence.